stand by. Good day and welcome to the Greatest Hits Program Income Conference Call. Today's conference is being recorded. At this time, I would like to turn the conference over to Marcia Tonkovich. Please go ahead, ma'am.
Thank you. Good afternoon, everybody. This is Marcia Tonkovich with ICF, and I know I've met and spoken with many of you over the last couple of years of NSP. Sorry we're a few minutes late to start here. For those of you who may not have heard, there was an earthquake, actually epicenter in Virginia outside of D.C. So it looks like, I think we figured out it was about a 5.8 is what they're reporting. So unfortunately, a lot of the phone lines are knocked out, and some of our HUD colleagues who were scheduled to be on the call with us today, we believe were evacuated from the HUD building because we had lost connection with them. So hopefully they will be able to join us later in the call, but we just wanted to let you guys know, and so it may be that we'll have folks joining us later from the east as the phone lines are back up. It looks like some of the cell phones are out. So hopefully, hopefully everybody will be able to join us later. It looks like it was, at least so far as we can tell, it was fairly mild, and hopefully everybody is okay. So because we have so many folks who are dialed in, we've decided to go ahead and proceed with the webinar, but there may be a couple of places where we will hold questions for when the HUD attendees are able to dial back in and to join us. So with that, we'll go ahead and proceed, and hopefully everybody is able to call in later. So as I mentioned, my name is Marcia Tonkovich. I am with ICF, and we have been doing the training on program income for HUD. There was a previous version of this webinar that was conducted in April, and this is an updated version of that webinar. And I'm joined today by a co-trainer with Janine Cuneo. Janine, do you want to say a word about yourself?
Hi, everyone. Janine Cuneo. I've had the pleasure of doing several of these webinars on DRGR, and I'll be focusing on how to do program income in DRGR today. Great.
And Vinny Grady from ICF will be there helping in terms of if you have any questions about the connectivity or having any issues, Vinny can help you out with that. So if you haven't been on one of these before, the way to ask questions on these webinars is to change your live meeting status from green to purple. So if you go up to the top right-hand corner where it says feedback, and if you look there, you'll see there's a green button. It should be green right now. And if you click on it, you can see that if you change it to purple, it's to ask a question, and that will help us to know how many questions we have in the queue. And then you need to press *1 on your phone, and that will put you into the audio queue, and then you can audio ask your question. If someone else already asked your question, and so you no longer need to ask it, press *2 to get yourself back out of the queue and change your button back to green. And that'll help us keep a handle on how many people we have waiting to ask a question. You can also, if you would like to type it in, if you're having issues with the audio or don't want to ask your question in audio, you can also go up to the Q&A box at the top left-hand corner of your screen, and you can click on it, and there you can type in a question, and then we'll be able to see that, and we'll manage those questions as well. So, Vinny, I'll ask that if you could manage those questions for me as we go through.
Sure.
Thank you. So our agenda for today, we're going to talk about what is and is not program income, and there are some new policy clarifications that we need to make sure we spend a moment on. And then we're going to talk about how you track it in DRGR and report it in DRGR. We will then have an open session to take your questions, so we'll have at least 45 minutes, hopefully a little bit longer to take your questions. We think the presentation will take about 75 minutes, and then the questions for 45, and that'll get us to 4 o'clock. Based on past grantee feedback to HUD, we used to sort of stop in the middle to take some questions, but folks had asked if we could get through the entire presentation and then take the questions. So we're going to go ahead and try that for this one and hopefully get your feedback on whether that works for everybody or not. So there are a number of resources that are out on program income. Probably the most important one is the recent policy alert that came out in July, and you can find it on the NSP website if you go to the resources section and you search on policy alert. You'll see it's the most recent one, and that policy alert has additional definitions of what is and is not program income, additional information, as well as some examples so you can kind of see how it plays out in the real world, and then some information on DRGR as well. We're going to cover all that information in this webinar, but more detail is available in that policy alert. In addition, you really want to go back and look at the NSP combined program notice that came out in October of last year. that notice, which set out sort of clarifications of policy for not only NSP 1 but also NSP 2 and 3, had a little section on program income that is going to cover some of the key things we're going to talk about today in terms of policy clarification. So it's important to read that as well. You can also find a whole series of Ask a Questions on program income. If you go to the NSP website and you search on program income in the Ask a Question function, you can see some past questions people have asked. And then finally, all of this is, of course, grounded in the CDBG rules, which specific to program income, you're going to want to look at 570-504 for sort of the what is and is not program income. There's also a definition of program income in the definition section of the CDBG rules. So let's start with that definition and talk about what is counted as program income and then what is not counted as program income. And then we'll talk about some of the recent policy clarifications and then a few additional other items before we jump into DRGR. So program income, let's stand back from it for a second before we talk about it specifically. And let's talk about it in general, and then we'll get into the specific types of PI. So think of program income as money that is coming back into either the grantee or a subrecipient, and that's going to be key, coming back into the grantee or a subrecipient because you spent NSP funds on an activity. So you spent NSP funds, that activity generated money or cash coming back to the grantee or to a subrecipient. For the most part, that money coming back in is considered program income. Now, a couple of things to pick apart in that. First, notice that I focused on the grantee and the subrecipient. Money coming back into developers or individuals or other types of organizations is not program income. Program income is only earned by the grantee. So that's the grantee is the organization that signed the grant agreement with HUD. So the city, the state, the county. In NSP 2, it might be some of the consortiums and others, but it's the entity which signed the grant agreement with HUD is the grantee, or a nonprofit or public agency whom they have designated as a subrecipient in a subrecipient agreement, money coming back in with that subrecipient. So whether the money is held by the grantee or held by the subrecipient, that money coming back into them is typically program income. Money that comes into a developer that you let the developer keep is usually not. But if the developer takes that income they receive and they then pay back the subrecipient or the grantee, then the point at which it comes back to the subrecipient or the grantee, it becomes program income. So let's talk about some of the specifics of types of program income and which ones are common under NSP. So the first one is probably the most common type of program income we're seeing under NSP, and that is proceeds from sale. So you've gone out there and you've used NSP funds, or your subrecipients have used NSP funds, or even your developers have used NSP funds to acquire and rehabilitate or construct, develop a property. And then you've done that, and then you go to sell that property to an individual home buyer. When that home buyer gets a private mortgage and buys the property from your developer, from your subrecipient, and that money comes back from the developer to the grantee or to the subrecipient, that money coming back into the grantee or the subrecipient is program income. If you allow the developer to keep that money and not pay back the subrecipient or the grantee, then it's not program income. But we'll talk about some issues with that, with allowing them to keep sales proceeds. So that's the most common one. The second most common that we see is the principal and interest on NSP loans. So you use your NSP funds to make a loan to a home buyer or a loan to a developer or whomever might be borrowing money from you. And that loan goes out, and it could go out with 0 interest, it could go out with 5% interest, whatever interest you're charging. The principal repayments and the interest repayments, so both, are considered to be program income for when it comes back again to the grantee or the subrecipient. Finally, I think the third most common one is recapture. So when you go out there and you do an affordable home buyer unit, and that home buyer has a period of affordability, 5, 10, 15 years, and during that period the home buyer sells the home to a different home buyer, a different homeowner, when the money comes back to you to pay you back as a part of that recaptured process for that secondary sale, that money coming back in is considered to be program income and is treated as such. Now, you should know that that's different than the home program. For those of you guys who run home, it's not considered recaptured funds as it is under home, but rather under NSP it is considered to be program income. next one is one that shouldn't happen, at least not very much, which is that if you've got program income that's sitting in a bank account and you haven't yet spent that program income, so it's not yet been dispersed from the bank, and it's earning interest in the bank while the program income is pending disbursement, that interest on program income is also program income. Now, the reason why it shouldn't happen very much, and we'll talk more about this later, is you're supposed to use program income first before you draw down other money out of your grant agreement or your DRGR account. So you shouldn't have money sitting in the bank for very long because that means you're not spending your funds, you're not drawing from DRGR. So hopefully money is not sitting in a program income account for very long pending its disbursement. If you do a demolition, and the way you decide to do demolition on a private home, so Mrs. Jones owns a home, and you're going to pay for the demolition of that home, and in order for her to allow you to demolish that home, you place a lien on that property. And in some way, she repays you for that lien because you paid for her demolition. That repayment of the lien, because you did the lien in order to do NSP demolition, is program income. Next one. If you have a rental property which is owned by a subrecipient, so this is the key, or the grantee, not rental property owned by developers or private owners or chodos or whatever it might be, but owned by the grantee or subrecipient, and that rental property earns net operating income, right? So, and net operating income is gross income, rents, and other kinds of income from the property minus expenses. If there is an NOI on that property, that NOI on the property owned by the subrecipient or the grantee is considered to be program income and does have to be used for eligible uses. And we'll talk about how you can use it to pay debt service in just a moment. So here's an example of how that works. So if you have rental income of $40,000 and you had $30,000 of expenses, the leftover NOI is $10,000. The program income is $10,000. And then you are allowed to use that $10,000 to pay private debt service, so not NSP loan, but private loan debt service. And then after you pay the debt service, whatever is left over is the PI that would have to be used for another eligible use following the NSP rules. So the circumstances under which you can use program income to pay debt service when you've got the subrecipient or grantee that owns the property is when it's for a private loan. So obviously if you own the property or a subrecipient owns the property, you're not going to use it to pay yourself. So it's only going to be in the situation where it's a private loan, and the private loan that built the property, that is the loan on the permanent financing on the property, was used for eligible activities in an eligible way according to the NSP, all the other NSP rules, and that it was solely to finance that project. It wasn't for some takeout loan for the owner or something like that. And you've thought about this up front, and your agreement with the property owner, or if that's the subrecipient, or with the lender, is that you will use NOI to pay back this loan. So only private loans, and only when it was done in accordance with all the NSP rules. So that's sort of a good definition of what is and is not program income. Before we move on to what is not program income, I want to ask our operator, Rochelle, if we have any of the HUD folks have been able to join us again. Rochelle, do we have the HUD folks back on?
Okay. If they are speakers, well, their line will be open.
Okay. So David or Hunter, are you guys been able to join us? No, it may be that the phones are still out down there. Okay. So let's talk about what is not program income. So the first thing is, if you have income in a single year, so in one grant year, one program year, and the income from all of the grantee and all of its subrecipients, so everybody all together, is less than $25,000, then that income coming back in is miscellaneous revenue and not program income, not subject to the NSP rules. Now, key thing is, it's not $25,000 per subrecipient. It's $25,000 for everybody all together for the year. So you have, in order to see if you hit the threshold, you have to add everybody's program income together If that program income from everybody altogether goes over $25,000, then the entire amount is program income. So it's not like the first $25,000 is sort of free and clear. It's if you go to $25,001, then the entire $25,001 is in fact program income. So what that means for most of us in this program, where we're getting, some amount of cash back and it's unpredictable, it's highly unlikely that anybody is really going to have less than $25,000 in a year. And even if you predict that you're going to, because maybe your houses won't sell till next year or whatever, your loans won't get paid till next year, you need to be cautious about it. Because if somebody prepays a loan or a house sells earlier than you think it's going to sell, and all of a sudden you get that money coming back in and you've gone over the $25,000, if you spent the money thinking it wasn't going to be program income and you spent it in ineligible ways, you've now got money you owe back to HUD. So we strongly discourage using the $25,000 as if it were non-program income unless you're absolutely, positively, 100% sure that you're not going to go over the $25,000 threshold. So for most of us in NSP, this is not likely to be an exemption to program income, but for a few people it is. If you have subrecipients who are doing fundraising, bake sales and car washes and whatever else they're doing, those proceeds are not program income because they're not generated because of NSP. So those proceeds from their fundraising is their income. Similarly, if you do a special assessment where you've got a public facility and you charge a special assessment on that public facility, that would also not be program income, although, again, because public facilities, particularly public facilities with a special assessment, are very rare in NSP, this is, again, not likely to happen. What else is not program income? If the grantee does a cash advance and there's interest earned on that cash advance, that is not program income, nor are funds that are held in a revolving loan account. So a revolving loan fund that you have capitalized with program income and you're lending out of the revolving loan fund. And prior to when the loans are made, that money is sitting in the bank, and that bank is paying interest on the revolving loan fund. That interest on the revolving loan fund, not the principal interest on the loan, but on the money sitting at the bank, is not program income if, in fact, it is a revolving loan fund. However, the reason why both of those, the cash advances and the money sitting in the revolving loan fund, are not program income is because it's actually money that none of us get to keep, that goes back to the U.S. Treasury, and there's a good reason for it, which is, if you think about it, if you're doing a revolving loan fund, it's supposed to revolve. And so if the money is just sitting at the bank earning interest and not actually revolving, then you're kind of defeating the purpose of the RLF. And so to discourage you from doing that, Treasury makes you give back the interest back to HUD and then back to the U.S. Treasury. So while particularly happens in revolving loan funds, while for revolving loan funds, the principal and interest on the loans that are made to an individual borrower, to a developer, whomever, that is program income. But the interest on it while it's sitting at the bank is not. Few more what are not program income, and this one's probably one of the more real exceptions to program income, which is if you have a subrecipient who buys property with NSP funds, and then 5 years after you have closed out the agreement with that subrecipient, disposes of that property. So let's say under NSP 1, under eligible use E, and again tied to an NSP activity, so assume it was eligible, a subrecipient did some sort of public facility, a community center or something like that, under NSP 1. And 5 years after they finish out the NSP grant and they've closed it out with the grantee, they then go to sell that community center. The proceeds of the sale of that community center is not program income as long as it was 5 years after the closeout of the grant with the grantee. Next one that's not program income, if you do have me working with a CBDO, Community-Based Development Organization, and for those of you who don't know, a CBDO is sort of like a CHODO. It's a nonprofit organization doing development under typically the CDBG program, but it could be under the NSP program. And that development organization is locally based with a locally based board, and I won't get into all the details of it. If you allow that nonprofit development organization to retain the proceeds, that nonprofit development organization is is not a subrecipient, and therefore the money coming back into them is not program income. Now, in order to count as a CBDO activity, it does have to be tied to affordable housing and meet all the other NSP rules, so none of that goes away. It's just that the type of organization is a CBDO. Finally, if we have money that comes back into anybody else who's not the grantee or subrecipient, individuals, contractors, owners, whomever, none of that money is program income, and we'll talk about that in just a moment. So, for that money that is earned by households and developers, it used to be that when the NSP rule first came out, it appeared to say that developers had to give the money back to grantees, that the money had to be reverted back to the grantee at the time of closeout or at some point in the process. That was changed early on. So that is not the case. Developers are not required to give back proceeds of sale or other kinds of proceeds they receive back to the grantee and counted as program income. That decision is left to the grantee itself. So when the grantee signs an agreement or the subrecipient signs an agreement with a developer, that agreement ought to spell out what's going to happen to any proceeds of sale, what's going to happen in the income earned by the developer, and the grantee gets to decide whether they want it to have it repaid to it, back to the grantee, or whether they want to allow the developer to keep it. If they allow the developer to keep it, it's not program income. If it gets paid back to the grantee, it is. Now, because these are end users, therefore we're exempted from this issue of being program income, but there is the OMB circulars to still worry about. And one of the things that the OMB circulars say is that costs and projects and returns to developers need to be reasonable. And so if you allow a developer to go out, build houses, and keep the entire proceeds of sale, if you have used NSP to construct that unit, that is in fact making their developer fee bigger, because they've earned a developer fee for the construction, but if they get to keep the proceeds, that's just more cash in their pocket. And so you as a grantee, if you're in charge of this, need to be careful about allowing them to keep that amount of revenue, because it might end up being undue enrichment or too much return to them. So you need to decide one of two things, if that's the case. Either have the money paid back to the grantee or to the subrecipient to be used as program income for another eligible use, or dictate what happens to that money this developer gets to keep and dictate that it has to be used for another NSP unit, following the NSP rules and all of that. But you can't just let them keep it if the sum of that amount of money they would be keeping plus the developer fee they have already received is in excess of what would be reasonable. Now, another way that you could earn money is something called an applicable credit. And what an applicable credit is when you've spent NSP funds and there's a credit against that expenditure. So, for example, there's an accidental overpayment on closing costs, and so at the closing table. And so you get a rebate back of the $100 difference where, sometimes when they estimate closing costs, they estimate it and it's a little bit off, and later on you get $100 back because of this miscalculation of the closing cost. That $100 back isn't really program income because of that sort of mathematical error in figuring out the closing cost. It's what's considered to be an applicable credit or an offset against the NSP expense that you had already put in. And so it comes back into the grantee. It still has to be used for eligible uses. It still has all the same requirements, but it's not program income, and so you don't get to take the 10% for admin, and the 25% loan from set aside does not apply to it. And we'll talk more about that in just a moment. So you can think of other kinds of applicable credits, insurance payments on NSP units. If you get a purchase rebate or discount when you buy something with NSP funds, any of those kinds of things which are offsets against an NSP expense are considered an applicable credit. Still have all the same rules, you just don't get the 10% admin. So we now need to talk about something that is one of the most important policies around program income, and an important clarification just to make sure everybody understands the rule. So the October 19th, 2010 combined notice, and there's a special section that talks about this issue, stated that the 25% set aside, which is the requirement that a grantee spend 25% of its funds on activities which benefit people at 0 to 50% of AMI, so activities which benefit very low-income or low-income persons. The change in October of last year said that 25% requirement applies not only to your original grant, whatever you were awarded through the formula from HUD, but also 25% of the program income that you earn. So the LH25 requirement does apply to program income as well as to your grant amount. And I'll show you a sample calculation of it in just a moment. That policy clarification became effective in October of 2010, and so it applies only to program income received after that date. So any program income you received prior to that date it was unclear about the 25% set aside. So part of the reason why HUD is reminding folks of this clarification does have to do with the intent of the NSP program, that, part of why Congress put in LH25 in the first place, and that's sort of the shorthand for the 25% set aside, is because there have been a lot of very low-income people who have, in fact, been affected by this foreclosure crisis. And we are now seeing a lot more rental units being developed with NSP. It's, in fact, one of the more common activities we're beginning to see. And therefore, they want to ensure that at least a proportion of those units are benefiting low-income and very low-income households. So that's sort of the background of this policy. The way it actually is calculated at the end of the term. So it's calculated at the end of when it's time to close out your NSP grant. This 25% calculation will be compliance must be documented at that point. So even if you're behind now and you haven't spent 25% of your grant plus your program income for LH25 activities, there's still time to catch up because, again, it's important that at the end of the day, you've at least hit 25%. About how that's working nationwide. That before, as of October 18th, there was $102,000, million dollars of program income. From October to August, there was in total, in August, there was $315 million of program income. So the difference would be 212. So 25% of that 212 of program income is how much we would have to have toward LH25. Hopefully that makes sense. It's only the program income after October of last year. So here's an example, and in this example, just for simplification's sake, I didn't deal with the prior to October, after October, so assume that all this PI is earned after October. So the grantee had $10 million of a total grant and $1 million of program income that they earned after October of 2010. So they had a total of $11 million. So the minimum threshold for LH25 then is $10 million plus $1 million of program income, or the $11 million times 25%, or $2,750,000 that is the minimum that has to go toward LH25. Now, as I mentioned, this does have to be done at the time of closeout, so you do have time to kind of plan for this and make sure that of the program income and the grant funds you have left, that you're spending a total of that minimum threshold, the 25%, for low-income activities, low-income housing activities. Now, as I mentioned, it's meeting the threshold that matters. How you meet it doesn't really matter. So, for example, you could spend very little of your actual grant dollars on LH25 and all of your program income on LH25, and as long as the total amount that you spend on the 25% set-aside activity is meeting that threshold we just calculated, you're going to meet the minimum. So the key here is, it's not that you have to take every receipt of program income you get, or every draw that you have out of DRGR and take 25% of that. What's important is that when you add it all together, whether it came from PI or it came from the grant, add it all together, the total sum of your expenditures was at least 25% of that threshold, was at least that 25% threshold, which is calculated based on the sum of PI and program and the grant. And we can take questions on that and work through some examples if people have questions about it. HUD's going to work with each grantee to make sure that you can understand the requirement and meet the requirement. There are some folks who are a little behind on this, and so there is TA available if you're struggling with this or struggling with meeting the LH25 requirements. I encourage you to go on to the Resource Exchange, that's the NSP website, and you'll see that there's something called Request Assistance, and you can go in there and ask for whether it's on-call help or it's for a couple of hours, or if you even need an on-site visit, someone to help you walk it through. The TA is free, so please take advantage of it, and you can go on and request it in that system. All right, so let's talk about the timing of program income. Program income is earned in perpetuity for the grantee. So if you're a grantee and if you sell a property or, sell a property that you have developed with NSP funds, and that income comes back to you 10 years from now, but it was built with NSP funds. When that income comes back into you, it is indeed program income. And we can talk a little bit about change of use issues, but for now on program income, when you go to sell a property or you get loan proceeds 10 years from now, whatever it might be, that money is still program income, even though you might be earning it many, many years from now. It also doesn't matter how many times it's revolved. So let's say you loan out money for an acquisition rehabilitation, it gets repaid to you. You loaned it back out for a second unit acquisition rehabilitation, and it gets paid back to you again. And then you loan it out again. Each of those revolutions, the program income, it is still the principal and interest coming back in is still program income. So it doesn't really matter how many times it cycles. It doesn't really matter when it comes back in, and it doesn't matter if it happens after the end of NSP in 2013. So you're going to close out your NSP program in 2013. You're very likely still going to be having program income coming back in after that point. It is still NSP program income. It still has to follow the rules, regardless if it comes back after that NSP closeout. Now, whether we're going to call it NSP program income or CDBG program income after NSP closeout is as yet unclear. HUD is working on a notice on this topic, and we hope to hear guidance on that fairly shortly. But what the current notices say is that after NSP closes out, the program income coming back in will be considered to be CDBG program income because CDBG will be going on. It's an ongoing grant program, and therefore treated under CDBG rules. Now, that's only the current policy. Nothing is finalized yet because there is no final closeout notice, so it may change, and I know HUD is looking at some flexibilities. But for now, I think you should assume that the money coming back in perpetuity will either have to follow the NSP rules or the CDBG rules, which are fairly similar, although there are some differences. So, in terms of how you have to use program income and how it's treated, there's sort of a rule called FIFO, first in, first out. And what FIFO basically says is you have to use your program income sitting on hand in a local account before you're allowed to go back and draw funds from DRGR. So you can't set aside program income and say, okay, well, I'm going to hold that program income for the next rental project or my next admin expense or when subrecipient XYZ needs money. You have to use the program income sitting on hand for the next bill that comes in, regardless of what that bill is and regardless of what the source of the program income was. So the program income was earned from homeownership activity, and the next bill that comes in is an admin activity, or the next bill that comes in is a rental activity, doesn't matter. The program income has to be spent on the next available bill that comes in the door. And obviously you can't just bank and hold the program income. It's been a problem in other programs in the past, and it's not something that you're allowed to do. So here's an example. So you have program income on hand of $35,000, and it was from the sale of a particular house. And you have a bill coming into your program for both your demolition program and your land bank program for $85,000. So even though the sale was a home buyer activity and the next bill is a demolition/land bank activity, nonetheless, you have to pay that bill first. And so the only amount that you can actually request from DRGR in this example is $50,000 because you have $35,000 on hand, you have $85,000 of bills, so you can't just draw down $85,000. You have to spend the $35,000 first, and then you can use draw $50,000 from DRGR. Now, there is an exception to that for revolving loan funds that we'll talk about in just a moment. but in general can't hold program income. Now, as we mentioned, the program income can be used to meet the LH25 requirements. It can also be used to meet your expenditure requirements. So as you know, you're required to expend 100% of your grant funds within the NSP period by 2013, and whatever your grant amount is, you must have expended it before that end period. Now, the question is, how does program income play into that? Because you have to spend the program income first, it counts towards your expenditure deadline. So in my example here, if you had an NSP1 grant of $10 million, and over the entire period you had earned $1 million of program income, then that means you have to have $9 million of your $10 million grant fund spent and your $1 million of your program income to get to a total of $10 million spent by the 2013 deadline. By definition, that means you'll still have $1 million sitting in DRGR at the time of the closeout, at the time of in 2013 when it's time to close that NSP, and that's okay. I note that that's going to happen, and that because if you have a lot of program income and you have to use it first, that may well be the case. So the key thing to know here is your program income earned and spent counts toward your expenditure deadline. Now, again, earned and spent, not just earned and sitting in the bank. Now, as I mentioned, there's an exception for revolving loan funds. So what can happen, you cannot capitalize a revolving loan fund. You cannot capitalize a revolving loan fund, but you can, but you can use program income to set up a revolving loan fund. So you get program income coming in, you set up a revolving loan fund, and that revolving loan fund then makes loans out of the fund, and money comes back in to the revolving loan fund. That money, those principal and interest payments coming back into the revolving loan fund is program income, and you can leave that program income sitting in a revolving loan fund waiting for the next similar use, in other words, whatever the purpose of the revolving loan fund is. So, for example, let's say the revolving loan fund is for home buyer loans, not for rental, not for construction, whatever, but it's for home buyer loans. You can, if you deposit the program income in a revolving loan fund and then make similar loans out of that fund, you can hold the money in that revolving loan fund for the next home buyer activity. So if a bill comes in for demolition or land bank or rental, you don't have to hit that revolving loan fund. You can keep it held just for that next home buyer use. But it does actually have to revolve. It can't just sit there and earn interest. We talked about the interest on it earlier. And it does have to be for an eligible use. It has to be for one of the eligible uses under NSP, and you have to be making loans out of that RLF using that program income. Now, there is an exception for capitalizing an RLF for the lump sum drawdown provisions under CDBG, and people are beginning to consider doing this. And that is that under the CDBG rules, and therefore under the NSP rules, you're allowed to do a drawdown where you deposit the funds out of DRGR into a rehab account. And that rehab account is then a specific eligible rehab activity. It's not for investment. It's for eligible activities. It's not for admin. And the idea is that you then make rehab loans out of that account. And there are some other criteria related to how quickly you have to draw and how quickly it has to be substantially drawn. And you do need HUD approval if you want to try this lump sum drawdown. But there are folks who are beginning to look at it. So, if you have questions about it, certainly send them into the Ask a Question or ask for TA help if you want to try a lump sum drawdown approach. Now, as I mentioned, the funds in the revolving loan fund are exempted from the FIFO rule, but it does actually have to revolve. So you can pay other bills while stuff is sitting in your revolving loan fund, but the next bill on that, the purpose of the revolving loan fund has to be paid out of the RLF. It does have to be an interest-bearing account, as I mentioned earlier, but that interest goes back to Treasury. So the interest into HUD, well, Treasury via HUD, the interest sitting on that revolving loan fund, not the principal and interest for the loans, but the interest paid by the bank is the interest that gets remitted back to HUD to Treasury. One key thing on a revolving loan fund is that every activity under the fund has to meet a national objective. So it's not just that, you can do it on average or something like that. Every single activity you fund out of the revolving loan fund has to meet a national objective. Okay, so You do have to then, because all these rules apply to the program income, you do actually have to track it, and we'll talk about the DRGR tracking of it. Every one of those activities funded with program income must meet the NSP rules. So it has to be an eligible NSP use, it has to meet the national objective, it has to meet all the cross-cutting requirements, Davis-Bacon, environmental, and so forth. But on the flip side, you do get to take 10% of the program income for planning and administration. And one of the things that people get confused about is they think that it's 10% of the actual program income dollars coming back. Really what it is that think of the 10% of program income for admin as raising your overall admin ceiling. So when you calculate your admin ceiling, you take 10% of your grant, and you say, okay, if my grant was $10 million and I can take 10% of it for program income, that means I could have spent $1 million on program income. What this says is that if you've got, $1 million for admin, $1 million for admin. If you earn $1 million of program income and you have $10 million of grant, that's $11 million total. You can take 10% of the $11 million, or $1.1 million, for admin. It's not that literally the dollars from the program income have to be used for the admin. Hopefully that makes sense. And if it doesn't, ask me in the questions and we can walk through how that would work. Okay. Now, it is important to track the program income separately for each program. So NSP 1, 2, and 3 may all earn program income. You cannot commingle the program income into the same account. You can't have the same tracking. You can't treat them as if they're all the same because they each have different rules. So NSP 1 has to follow the NSP 1 program rules, NSP 2 the NSP 2 rules, and NSP 3 its rules. And so you do have to track each of those program income separately. You can put them together into a project or put them together into a deal, but that deal has to meet the rules of all the programs. So if you put NSP 1, 2, and 3 together in a deal, that deal would have to meet the rules of 1, 2, and 3. Okay, so another common question that we've received is, well, what if I have a project that has multiple sources of investment? So it has CDBG money and home money in it and NSP money in it, and then it earns program income. So how do I figure out, of that program income, how much is attributable to home, how much is attributable to CDBG, how much is attributable to NSP? So what you do is you do a proration, and you say, what was the total development cost? And then of that total development cost, how much was paid by NSP, how much by home, how much by other money? And then when the proceeds come back, or the program income comes back, you prorate it based upon the proportion of the investment. So in my example, NSP was 60% of the total development cost of $100,000. And therefore, when the house sells, 60% of the money coming back to the grantee is program income. So in my example, $54,000. Since home was 10% of the total development cost, home gets 10% of the PI, or $9,000. And since the local money in my example was $30,000, local gets 30%, or $27,000. So we prorate the income coming back in according to the proportion of the development cost that was covered. Now, this only applies to money coming back into the grantee. We're not talking about money coming back to a lender or money coming back to the developer. None of that is program income. This is only the money coming back into the grantee or a subrecipient and how we're going to prorate it across the multiple financing sources. It is important to incorporate the program income within the agreements that are signed between the grantee and subrecipients, and talk about whether the subrecipient gets to keep the program income or they have to send it back to the grantee, and what they can do with the program income. So if you're the grantee and you sign an agreement with the subrecipient, you're going to let them keep the program income, then you have to say that it's going to be used for rental activities or home buyer activities or whatever you're going to allow them to do it with, which of course has to be eligible. Now, one of the common questions about subrecipients is, well, if the money is held at the subrecipient, if they get to keep the program income, then how does that affect the grantee's ability to draw from its DRGR account? And the answer is it really doesn't. The grantee can keep drawing from its DRGR account, even if there's program income sitting at the grantee, at the subrecipient. But the subrecipient cannot ask for another DRGR payment, another payment from NSP, until it has spent the program income it has on hand. So if your subrecipient has $10,000 on hand, the subrecipient recipient has to spend that $10,000 before coming back and asking for new grant funds. But the grantee, the city or state or county, can continue to spend grant funds even though there's $10,000 sitting at the subrecipient. Now, obviously, at the end of the agreement, when the agreement is all over, if there is program income sitting on hand at the subrecipient, the grantee has one of two choices. The grantee can either make the subrecipient pay the funds back to the grantee at the end of the program, or the grantee can dictate what has to happen with those proceeds and with that program income. In other words, build 5 more houses or renovate 5 more rental units or whatever it might be. So the grantee's agreement with the subrecipient has to spell out what happens at the end of the agreement to any program income on hand. So some of the options for using program income. You could do more of the same program that generated the income in the first place. So more homebuyer units, more rental units. You could move into a different eligible activity. So you could use your program income. Let's say it came from homebuyer activities, but now you want to do rental. You could put it into rental. The key is that activity obviously has to be eligible under NSP, and it does have to be in your action plan. You could give the money to new partners, different developers, new developers, or you could run a competition, or you could give it back to the same developers again. But the key is that the grantee has to spell all this out and how it's going to do it in its action plan. So I have a series of examples here about how program income might work. And I think what I might do is take a couple of questions just to see if we have anybody. I think we have one written-in question, and then we'll move into DRGR, and if we have time, we'll come back to these examples. So, Vinny, we have one written-in question. Can you give us the question?
Sure. The question is, do you have to have separate bank accounts for program income generated from NSP1, NSP2, and NSP3, or can you just track them separately in your accounting system?
Good question. And we can certainly put – is anybody from HUD on yet? No? Okay. I think that we got word while we were all talking that they were evacuated. So I don't believe you technically have to have separate bank accounts. I don't think you have to have NSP1 program income bank account and NSP2 program income bank account, as long as your accounting software is sophisticated enough to be able to track them each separately in sub-accounts. So, it depends on how sophisticated your accounting software is. What you can't do is just deposit it in one big account and then do some sort of pro rata thing or guesstimate how much is NSP1. You have to know, through your accounting software tracking, this is what's my balance of program income on NSP1, my balance in NSP2, my balance of NSP3, and then you have to use each of those according to their own rules. So it might be easier to have them each in a separate bank account just for ease of tracking. I don't think that would be the absolute requirement as long as your accounting system was sophisticated enough to be able to do that. Okay. Let's ask our Rochelle, our operator, do we have questions that are queued up on the phone? Rochelle?
Yes, if you would like to ask a question, please press star followed by the digit 1. If you are on a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Once again, star 1 to ask a question. And
Michelle, do we have anybody in the queue right now?
Yes, we'll take a question from Neil Goslin, Southhelp.
Hi, Neil.
Hi, how you doing?
Good. A little shaken. I keep getting all these emails as we're going along on the earthquake, so a little shaken up, but good to talk to you.
Yeah. Thanks for doing this anyway.
Sure.
So we have an NSP1 relationship. We're getting funding from the state of North Carolina.
Okay. And you guys are a nonprofit?
And we are a nonprofit. And program income is trickling in. It's trickling in. And I'm wondering, can I wait to return it until we hit that $25,000 threshold just for ease of accounting purposes?
Well, it depends on your relationship, and you're getting it from the state, you said?
Yeah.
Okay. So it depends on what you and the state agree to in terms of what happens with so you guys have been designated a subrecipient, I take it?
Right.
Okay. So one of two things could have happened. The state could say, pay us back, and then you should be remitting it back to them on a periodic basis. And it's not the $25,000 in this case. It's typically remitted back monthly, or it might be quarterly, whatever frequency the state requires. But you could be sending the money back directly to the state. or the state could let you keep it, and then you should be using it before you go back to the state for any new draws. So it depends on which way they set it up with you.
Okay.
Do you know what did they require of you in your subrecipient agreement?
It's not spelled out in the subrecipient agreement, but our understanding verbally has been quarterly.
Okay. I mean, it's a little bit, the issue with doing it quarterly is it's a little bit tough for the state because, you know, they're supposed to be using it first, and if it's just sitting with you guys,
right,
then you should be using it before you remit it back. So really they should be getting the remittances, I think, a little more frequently than quarterly if the intent is that it gets remitted back to them as opposed to you using it first. Because otherwise
right now we're just talking about a couple $100 at this point. So
all right. Well, so it might be that a couple $100 is you know, not a big deal. Although what would be cleaner to do would be to deduct it from the next draw you need.
We will be doing that.
Okay. If you're doing that, if you're deducted, let's say you have $200 on hand, and your next bill is $5,000. What would be the cleanest way to do this is to just say, okay, well, we only need $4,800 for our next draw.
Yeah.
Does that help?
Yeah, that'll help.
Okay, great.
Thank
you. Rochelle, anybody else on the phone?
Yes, we'll take a call from Mark Hamilton, the City of Merced.
Yes, we have a question about the program income.
Sure.
Basically, because when we spend the time, selling properties, whatnot, and how are we allowed to take the admin cost out for the sale of the real estate, the admin cost of the program income, basically, as we continue our admin costs through this process?
Okay. So that's what I was talking about the way the admin actually works. You don't literally take it out.
Okay.
So what happens? So tell me, your Merced?
Yes.
Is that your city's Merced?
Yeah, we have about 22 homes, and basically, as you can tell, as you try and sell and purchase properties, there's an admin cost associated with that, and we're just trying to make sure that we get all of our costs recouped for the admin costs, even though we're continuously buying and selling homes with our program income.
Yep, makes sense. Okay, so you're Merced, is that the city you're from?
Yes.
So how big is Merced's grant? Just give me a round number.
It's about $2 million.
$2 million. Okay. So of the $2 million that you have as an NSP grant, that means that you have $200,000, 10%, that you could have spent on true admin.
Right.
And the way that the cap works is when you get the program income to come in, you can take 10% of that program income and boost up your cap. So let's say you had $100,000 of program income.
Okay.
So if you take 10% of that, that's $10,000, right?
Right.
So of your $2 million, we said you could have spent $200,000 on program income with your original admin cap.
Mm-hmm.
Now when you get the PI in, you have another $10,000, that 10%. So your cap is now $210,000.
Okay.
So you don't literally have to take it out of the program income. It just says that you can't spend more than $210,000. You could actually take it out.
Okay.
Does that make sense?
So basically, you basically can take the initial grant plus the program income amount that you've accrued,
right,
and basically take those caps and add them together.
Add them together and then take 10%.
Okay.
That'll tell you what the total amount that you can spend on admin is, and so the more PI you get, the more you can spend on admin.
And I have a question for you. Because we've had this debate internally with our finance front, should we automatically extract that amount that we have for a cap, even though we don't expend it, but we at least know what that amount could be in a separate account?
Remember, you've got that FIFO rule, right? You've got that first in, first out rule?
Right.
So you don't, pull it out of the program income and put it in some admin account or something.
Okay.
And what happens is, again, it's raising the cap, but if the program income comes in and it's sitting in your program income account, you have to use it to pay the next bill, whatever that bill is.
Okay.
Whether that bill is an admin bill or whether that bill is a, project bill.
Okay.
Now, one thing I was going to tell you, if you were talking about some of those costs of selling off those homes and that kind of stuff, costs are not admin costs. And some of those things like inspections or selecting home buyers or underwriting, marketing, those sorts of costs are program delivery costs. You don't have to count them toward the admin cap as long as you keep a track of them and document them.
We do, yeah.
So don't worry, you don't have to worry about some of those kinds of costs with this issue.
Okay.
Does that help?
That does help.
Okay.
And I do have one last question, if you don't mind. I'm sorry. Because we have a lot of crime going on in our area, at least a lot of our homes are being broken into, we're looking at doing a security monitoring service. Can the security monitoring service that's monthly be charged towards the activity deliveries?
It's during construction or after construction?
It's after construction, but during the time frame that we're trying to market the property for sale.
Okay, so it's prior to when you've disposed of it to a home buyer.
That's correct.
So, yeah, I think that would be an eligible activity delivery cost or a disposition cost.
Okay.
I don't think it would be a problem as long as it was reasonable. You know, if it was $1,000 a month or something, that might be a problem. But within reason.
Right. Like $30 a month.
I'm sorry?
Like $30 a month?
Yeah, I think that's a reasonable activity delivery cost until the point where you sell it to the home buyer. And obviously you're not going to pay for it after that point.
Correct.
Yep.
Okay.
I think that would be reasonable.
Oh, thank you.
Okay. So why don't we go ahead, and I know we have some other questions holding, but in the answer to the DRGR section, why don't we go ahead and move on to DRGR, and then if we have time at the end, we'll come back and we can do these examples, and we'll also take additional chunk of questions. So, Janine, I'm going to forward you to the DRGR slides, and I'm going to turn it over to you.
Great. Thanks, Marcia. So I'm going to go through DRGR and program income, but before I even start, I want to let everyone know that there are planned enhancements to DRGR that will be coming up. As of this morning when I talked to HUD, those are targeted for November 1st of this year. And those are going to be changing everything I say going forward with regards to program income. Many of the enhancements will be directly related to program income so that after November 1st, and again I say the target date is November 1st, so after the date of the enhancement, you'll be able to, in DRGR budget, be able to do some budgeting of estimated program income in the action plan module. You'll be able to obligate. You'll be able to have a receipt screen for program income and the revolving loan funds if you're doing those. And you'll also be able to calculate the available balance for program income draws. So I just wanted to let you guys know that this information I'll be giving you today has a time period on it, and it will be ending hopefully this fall, late fall, early winter. And that does not mean, however, you do not track DRGR currently now until the changes. So you do need to continue to track DRGR in the way I'll talk about in a second. And when the new changes come up, then you'll be able to adapt to those new changes and go forward. When I hear the new changes, I think it will be able to really support you in doing some of the more tracking in DRGR than what you do now. Currently, it's a very simplistic version of tracking and program income. So I'm going to kind of go right into it now. And again, everything I say will have a time period end to it, and there will be additional information coming out when the target date, November 1st, is rolled out for the DRGR enhancements. So DRGR technically does not track your first in, first out of program income. You as a grantee are responsible for tracking the timing of draws for program income, and I highly recommend you do that in a separate internal system. Marcia talked about it a little bit earlier. You don't technically have to have a separate banking accounting system, but you do in your own accounting systems need to have separate tracking, and I highly recommend that program staff and financial staff work together on that. Program income received. Really in DRGR you have two options currently. It's program income received or program income dispersed, and that's it. The program income received, you're tracking that in grantees' quarterly reports in the activity, in the DRGR activity in which it was generated. When program income dispersed, you track that in the drawdown module, again, at the activity level for which it was used for. So let's talk through this a little bit. I want to make sure everyone understands that a grantee, when they track the program income received in their QPR, you just enter the information, i.e. if you received $300,000 for activity A, you would go ahead and receipt that or show received in your QPR. Some might say to me then, but Janine, I received that within the quarter. Do I wait till the end of the quarter? You're actually able to go into DRGR within the quarter, in your QPR at the activity, enter the information in, and just save your QPR. Do not submit it. You can just save your QPR, and you'll update that throughout the quarter as program income comes in. To draw program income, you'll be doing that in the drawdown module. The protocol is no different than what you do for your regular NSP program funds or grant funds, except in DRGR, when you're doing your drawdown module, you usually select program funds when you're wanting to use program funds, but there is also a section where you can select program income funds. Go ahead and select program income funds for the activity in which you want to draw down the funds for. Your available program income is actually the sum of all the program income that a grantee has generated. Okay? So you're looking at the grant amount, not activity by activity, when you're looking at how much you can actually draw down from. That same amount of money will be shown as available for each activity in a voucher. However, you're only able to draw down the sum of all of that. So if you have multiple activities in which you want to draw program income from, you need to think about the sum of the entire program income that you've generated to date. I just want to show you guys a report in DRGR. This is a module in DRGR called the Reports module. If you go ahead and open that up and you go to a financial report, this is actually FIN Report 5B for you grantees out there. 5B is the one that shows your program income at the activity level. Another good financial report is 5A, and that will show your program income at the grant level, so it won't go into the details you see here. Just wanted to show you guys that if you look at one of the activities, for example, I'm going to show you here, B, EDC, LMMI, you'll notice that the program income received for this activity is a little less than $1,961,000, and of that has been dispersed $755,000. Your program income received again is done at QPR, and your program income dispersed is done at the drawdown. So if I look at overall what this grantee has generated for program income, they've generated total about 1.286, and they've dispersed a little less than $1 million. What does that tell me? We're following the first in, first out rules. Their next drawdown should not be a program fund, will actually be program income funds, as they have funds on hand right now from program income. This is an example of a screenshot in DRGR, and this is literally at the QPR level, at the activity. There's a program income received line, and this is where you enter the current in-quarter estimate of program income received. Again, you save, not submit the QPR once you're in quarter, and you're able to continue to save that throughout the quarter if you have to make adjustments. This is the example of a drawdown module screenshot. Again, you'll notice here that there is a section for program funds and program income. So, for example, if we're wanting for the activity number SR22, if there are program funds to be drawn and program income, a grantee is able to select both the program funds and the program income in order to build a voucher. This is an example where a grantee has built out a voucher, and they're going to be drawing both program funds and program income. However, you might notice that for program income, it says the available amount for both of the program income line items. It's just $204,000. What does that mean? Again, the available amount of program income is the sum of all program income that has been received, minus if you've drawn any program income in the thus far. Okay, so this $204,000 is total of the grants, how much is on hand for that grantee, which means the sum of the draws in this voucher totals $204,000 for program income. You cannot go over that. So each line item doesn't have $204,000. It's the sum of the two. The math rules in DRGR, for those that are familiar, a lot of math rules you got to think about. So let me give you the program income math rules that I've just talked about. Again, it's the available amount of your program income is going to be the sum of all program income you've received to date minus any drawn program income. Let me walk you through an example of that. Okay, so this grantee has received, let's say, a little over $300,000, $304,426. They've drawn to date $100,000. So if we go back to our math rules, the available amount is program income received minus drawn. So today, the available amount for this grantee is $304,000 minus the program income has been drawn, $100,000, so they right now have available $204,000. So you notice I see here, activity 1 can be anything up to $204,000, and activity 2 would be the difference of that. Both activities cannot draw as a sum more than $204,000. Okay, this program income, $304,000, is continually increased as you, the grantee, continue to receive program income. Okay, so that $304,000 will continue to go up as you receive. Continue to do that in your QPR. So let's talk about some common problems grantees find in DRGR these days. So the first one is we often get, how do I demonstrate a revolving loan fund in DRGR? DRGR, you're going to be entering a new DRGR activity, and what you put for the budget is actually 0. But like with any other new DRGR activity, you'll need to completely fill out that information. So you'll be able to tell the national objective, you'll be able to tell the activity type in which you're doing it for. If another a subrecipient is going to be doing the revolving loan fund, you'll need to put the responsible organization and any performance measures you're proposing to meet with that revolving loan fund. Okay, so like any other new DRGR activity, you'd fill out all the other applicable information, but on this example, you put a 0 budget. Where do you put the information for the program income received that's going to be dropped into the revolving loan fund? In the QPR. Okay, so in the QPR, where you put program income received for the revolving loan fund, you put the revolving loan fund dollar amounts there that grows. Question 2. So we often get, I received program income from, for example, the acquisition rehabilitation activity, but my next draw is 50% for the acquisition and 50% for redevelopment. What do I need to do? So when you receive the program income, again, you go into your QPR and you receipt that, and then your next draw, it's okay that it's not the same as what you received it for. You actually have the opportunity then to draw from your acquisition and draw from your redevelopment. It's the sum of all the program income received, regardless of activity in which you're able to draw from. Let me just show you guys that for a second. At the activity level, let's say, this grantee receives $325,000. Then the next draw is actually for both activities, the B, EDC, LH25, and the E Habitat LH25 activities. Therefore, the $325 is not going to be drawn straight from B, EDC, LH25, but from whatever the next money is that you need to draw, which in this example was the B, EDC, LH25, and also the E Habitat LH25. Let's go back and see what question number 3 was. This is a little bit more complex in advance. Let me walk you through this. We often get, so my next drawdown is for an activity that I'm calling a capped budget. What do I need to do in DRGR? Okay, so a capped budget in this example is, for example, let's say you are working with a subrecipient and you have a contract with them for X amount of dollars, and you as a grantee have decided that they will not be using any of the program income. You're getting it all back and have chosen to do something else with the program income. That means you never want their dollar amount that received over X amount. So currently in DRGR, again, this will change, but currently in DRGR, you may need to go back to your activity budgets to make that work. So let's walk through that. As always, some context for you. The grantee still needs to do the first in, first out rule to disperse the funds. So the grantee can decrease the activity budget for which the program income was received, and then they'll increase the activity budget in which the program income is going to be designated for. And this occurs because activity drawdowns plus program income draw equals your total activity draws. Let me walk you through this example a little bit. So let's go with one of the line items here. For the E Habitat LH25, they currently have a budget of $824,000 of grant funds. They've currently dispersed of those grant funds $169,000. And then they've also, because the draw was next, had to use program income also to pay the eHabitat LH25 line item of almost $36,000. So total, this responsible organization for this line item has received almost $205,000 worth of draws. Okay, so in order to work this out, if Habitat for Humanity, for example, in this case, the grantee has decided they're not going to be getting any of the program income. They want all the program income to come back to the grantee, and the grantee is choosing to actually put all their program income into another activity, for example, BEDC LMMI. Okay? So since the grantee is choosing that, they must decrease the eHabitat LH25's budget by the program income dispersed against that activity, and they're going to subsequently increase the budget of BEDC LMMI by that same amount. Why is that? Because, as we said, the total funds drawn to date of $204,000 is the sum of the program income drawn plus the program funds drawn. And if you continue to draw this program income dispersed, this $824,000 of the grants fund budget keeps increasing by whatever the program income has been dispersed. And you do not want, as the grantee has decided, they do not want eHabitat's funds to ever go above $824,000. So in the next slide, I'll show you what the grantee has done. They went ahead and decreased eHabitat funds by the exact program income disbursement amount. So their funds now are $788,000, and they've increased where they want to be using the program income, which is the BEDC LMMI category, to over $4.5 million. Again, this is only for a time when you have capped the budget as eHabitat LH25 or an activity is capped, and you do not ever want to increase the amount, but yet you have to follow the FIFO rules and disperse the funds as necessary. Marcia, I'm done with DRGR here. I'm happy to pass it back to you if you'd like.
Okay, terrific. Well, let's go ahead and take some questions. I see that we have about 6 or 7 questions, and at least people have turned their dots to purple. And I think we have a couple written in questions as well. And then we'll go ahead and, if we have time, we can go through the examples that are in the PowerPoint also. So let's take some questions now. So, Rochelle, can you open up the phone lines and take our next question?
Sure. And once again, to ask your question, it's *1. And we'll move on to Albert Ramos with City of Orlando.
Hi, Albert.
Hi, Marcia. Thank you for taking my call. I just have a very quick question. We have about $7 million initial funds, and we have spent about more than $6 million. Therefore, we have about $1 million left, but we're using program income to pay for all our expenses. What happened at the end of the program that when the program is complete? What's going to happen with that $1 million left into our account?
It's a good question. First, the good news is that you don't lose it. It's not like it's going back to Treasury. Originally, there was some fear that that would be the case. That is not true.
Mm-hmm. Okay.
So as long as you said you had $7 million as your grant, right?
Yeah, around that, right.
So as long as you have spent a total of $7 million by 2013,
okay.
And that could have been PI or it could have been grant funds or some combination, as long as you've spent at least $7 million, then nothing happens to the funds that's sitting in your DRGR account. What we don't know is whether you get to continue to use it under the NSP rules or whether they'll then make you use it under the CDBG rules. But it'll be something or some combination of either one of those. And as I said, we don't have a closeout notice yet, so we don't totally know. But I think you can assume it'll be either NSP or CDBG eligible activities with that $1 million that you have left.
So it's the same thing that is going to happen with the program income that we will continue to receive.
Yeah, I think that's right. And again, we don't totally know yet, but it'll be something along those lines. You know, it might be the same NSP rules, but it won't. You're not going to lose it. You're not going to have to remit it back to Treasury or anything like that. I don't think it's going to get a whole lot looser. You know, it's not like you're going to get to spend it on whatever you feel like it. It'll probably just be more of the same.
All right, Marcia. Thank you again for your help.
We're happy to help.
All right. Bye-bye.
Bye. Okay, Rochelle, who's next?
We have Rosa Reyna with City of Port St. Lucie.
Hi, Rosa.
Hi, how are you?
Good.
I just wanted to clarify on the 10% and the raising the admin cap, because on our program income, we've basically put it into Excel with a formula that any property that we sell, the money that comes back to us, 10% we put aside for admin and the 90% to go back into projects. So in your example of the $10 million grant funds and the $1 million program income, it ultimately, to me, seems to work out the same. So I don't know, I'm a little confused there.
Yeah, it's the problem is the first in, first out rule. So you can't really, remember I said earlier when I talked about the FIFO, that you're not allowed to sort of hold funds for a specific use. Like you can't say, okay, I've got this PI coming in, and I'm going to hold it until the next project, or I'm going to hold it for admin.
Right.
So you can't, when you get your program income coming in, and you've got it in your tracking spreadsheet, which is good, you can't sort of take that 10% that you want to have for admin, the 10% of the PI, and hold it until you have an admin expense. It's more like what the PI does is enable you to raise the entire cap on how much you can spend on admin, but you can't just hold that 10% of the money in some account waiting for an admin expense. You have to actually spend it on the first bill, whatever the first bill is.
Right. So if there's a need, what you're saying, if there's a need to use it for project expenses because we don't have any other project program income on hand, then we have to use that money.
Exactly. So it doesn't really matter what the next bill is. What matters is that the next time you get a bill, let's say in that 10% that you put, let's say you have, I don't know, $10,000 sitting in that amount that you sort of were holding for admin. But if a bill comes in for rehab, and that bill is $50,000, you have to spend that $10,000 you have sitting on hand, even if you were sort of holding it aside for admin. You got to spend that $10,000 on that $50,000 rehab bill, and then you can go back and take $40,000 out of DRGR for the balance of that rehab bill. But you can't leave the $10,000 sitting there for admin and draw down the full $50,000 for the rehab bill. You have to spend that $10,000 first.
Right, I see what you're saying. Well, I guess, that makes more sense to me. But as a rule, we're running, if anything, we're running shorter on the admin side than anything else.
Yeah, and again, just think of it as just cash. The program income coming back in is just cash that goes to pay the next bill, whatever that is. But
okay, well, on the flip side, let me use this scenario. Okay. We're running pretty close on the admin as far as the program income goes. So in any given month, if we're short on admin to cover admin costs for that month, instead of drawing from the line of credit, are we to then take it from what we set aside for the projects then?
Yes. Again, whatever your first bill is.
Got it.
So let's say that you have instead of $50,000 of a rehab bill, you have $50,000 of an admin bill, salaries to pay or, some contract you have to pay or something.
Right.
You're going to pay that cost, whether it's out of grant funds or program income on hand, but you're going to pay that first cost that comes in. The only caveat is make sure you never spend in total more than your cap on admin. So make, if you're running pretty close, make sure that when you look at all of your admin expenses and you look at how much you've spent on those admin expenses, you don't exceed 10% of your grant plus program income.
So we haven't exceeded, and like the City of Orlando, the gentleman just before me, we have approximately like $1 million or a little under that left of our original grant. But then what I've done at least on one occasion is that if we didn't have program income that was set aside for admin, then I would draw down from the grant what I needed for admin only, because all the other money was, in our scenario, set aside for the project activities.
Totally fine for you to go ahead and go back to DRGR and grab more money to pay for admin, as long as the sum of everything you spend on admin doesn't exceed.
what we originally had plus plus the additional 10% of all the program income earned.
Yeah, so what it should be is you take your original grant,
Right.
all your program income, and then multiply that sum times 10%, and that is your ceiling.
Right. And then plus the 10% of the total program income.
Well, right. So what I would do is I would take my total grant,
Yes.
total program income, and that gives you the denominator.
Right.
And then multiply that by 10%, and 10% of that sum is your cap.
Got it.
Got it?
I got it.
All right, cool.
Thank you.
Sure. Okay, next question, please, Michelle.
We'll hear from Mitchell Glasser with Orange County Government.
Hi, Mitchell.
Hi. I have a question on the low-income set-aside.
Okay.
Basically, the way you just described how you would calculate the admin for program income with 10%, are you basically in your presentation saying to do the same thing for the 25% low-income set-aside, and that's everything, after October 2010?
Yes.
You're saying to do pretty much the same type of calculation?
Exactly. So you would take your total grant plus your total program income after October of 2010, and you would take 25% of that, and that would be your minimum rather than your maximum. In the case of admin, it would be your minimum for LH25.
Right, and then that keeps obviously increasing as your program income goes up.
Exactly.
Okay, and what is it that, after 2013, our closeout, that we're basically closing out meeting all of our expenditure requirements of the NSP, not just program income, because program income could be coming in for years.
Exactly. Exactly right. So what you're going to close out in 2013 is the NSP program, in the sense that you'll still have to monitor it, you'll still have to track it and everything, but there won't be any. The program itself will be closed out, and so you might well have money still sitting in DRGR if you had a lot of program income, and you certainly could have program income coming in after that point. And what we're saying is, just because the program is closed out doesn't mean the rules go away. You still have to follow all the rules.
So the program income will still be basically in effect, and we'll still be reporting in DRGR our program income.
Well, that's a good question. I don't think we know the answers to that yet about what's going to happen in DRGR after program closeout. I don't know if it switches over to IDIS or what. Do you know?
But so would the 25% rule stop at 2013 then?
No, it's still going to be, from our understanding, it's going to be 25% of all the program income period.
Forever, whenever you get program income.
Whenever you get it. Now, again, this might change as we get to the closeout notice from HUD, but our current understanding is it's 25% of all the program income. So, Jean, do you know what happens with DRGR at closeout in terms of reporting and tracking PI?
I have not heard anything that it would switch over to another system or anything like that. From all intents and purposes that I've heard at this point in time, it will stay in DRGR, but that is official notice that is yet to come.
All right, thank you.
Sure. Okay, Rochelle, who's next?
Next, we'll move to Peg Anderson with North Dakota Department of Commerce.
Okay, hi, Peg.
Hi. I have a question about the actual screen that's up right now, the question 3.
Okay.
You've reduced the budgeted amount in the third line. Oh, no, go back.
Got it. Sorry. That was my fault.
Okay. You've reduced the budgeted amount, but what about the obligated amount?
Thank you. I'm glad you noticed that nuance. Yes. So as in DRGR, you always have to reduce the obligation as well as the budgeted amount whenever you're doing that. So you would first reduce the obligation, then the budgeted, and then you're able to increase the budgeted.
Okay, I've been doing it that way, and I'm like, oh, I've been doing it wrong.
No, you're right. Okay. You're right. I didn't go into the full details of how DRGR works and functions, but that is 100% correct. So for folks that are wondering where this nuance is that in DRGR, you're not allowed to reduce the budget less than your obligated amount. So correct is that you would decrease obligation first, then decrease budget, and then you're now able to go into the budget. And I'm going to go one step further for those that are advanced DRGR folks out there, or even intermediate, not just decrease obligation budget, but you may have to also go to your project line. So in this example, we're actually flowing between two different projects. If you notice, the E redevelopment is one of the projects, and then you also have, and then you're moving the money to a whole different project, B, acquisition rehab. So you actually have to decrease the project budget as well and increase the of E and increase the project of B if you are currently fully budgeted at your project level as well as your activity level.
And what's so difficult about that is that's an amendment change that has to be approved.
Yes.
At our regional level.
Yes.
And do you guys realize that that can happen weekly, and it may take an extra week to even get that approved?
Can I make a suggestion to you?
Yes.
That is true, and that is actually one of the reasons why they're making the enhancements to this, so that it will be more transaction-based. And it is my understanding currently the way that they're reprogramming this that hopefully it will minimize that. But in the meantime, I would like to suggest that you think about not actually going back to your action plan and submitting that every week. Rather, think about a timing that you actually maybe could keep your action plan open for a certain period of time, maybe, and work with your field office rep around this, but maybe, up till, the end or close to the end of when the quarter ends. Turn it in, have them, ask if you guys work on a timeline where they submit it back in a week or two, and then you do your QPR. But if you do it in a way where you keep it open and keep saving every change versus always submitting every change, again, thinking about your timeframes and the interaction with QPR, you could actually keep that action plan open for a while. And every time you receive that money, you don't actually need to have that action plan approved in order to draw it down.
Right, and I agree with you, but if I get a draw the next week for that same project, and they need, and say it's their last draw and they're going to take it all, and it's the one I increased, then I have to submit it.
And why do you feel you have to submit it?
Because you can't draw more than what's obligated. So,
but obligations and draws, actually, you can do that and not have to have an approved action plan in place.
Really?
Yes.
I did not know that. Okay,
yes.
Great.
Try it next time. If you're still struggling through it, don't hesitate to do the request additional TA, and we can walk through that, or another DRGR expert can walk through that. But you do not need to have that in approved status, either your QPR or your action plan, to make changes to the program income or to draw.
Okay, so you really only need an approved action plan then to submit your quarterly.
Correct.
Okay. Does
that help?
Yes.
Great.
Thank you.
You're welcome.
Great. Okay, Rochelle, do we have anybody else on the phone?
There are no further questions at this time.
Okay, well, I have some on the call, or on the written in, so let me go ahead and go through some of those. So I have a question from Kaya, and Kaya, if you have a follow-up, just let me know. Her question is, we have NSP 1 and NSP 2 agreements with particular subrecipients. Most of the properties have a combination of NSP funds 1 and 2. We are allowing the sub to keep program income for NSP-eligible activities. As PI is coming in, they are dividing the PI between the programs based on the proportion of funds invested, which is correct. The sub has spent all their NSP 1 grant funds and are not requesting any more draws for NSP 1. They are requesting NSP 2 draws for additional properties that also have a combo of NSP 1 and NSP 2. Is this allowed? So I think if I'm understanding Kaya's question, they've got NSP 1 PI on hand, but are done with their NSP 1 grant, the subrecipient is, and yet they're trying to draw NSP 2 funds for this project. Now, if the project has both NSP 1 and NSP 2 in it, so it's not just an NSP 2 project, then I think they would have to use the NSP 1 program income before they could make an NSP 2 draw. If the project, however, had no NSP 1 funds in it and it was just an NSP 2 project, I don't think they'd have to spend the NSP 1 funds before they could draw funds for an NSP 2 project because, again, they're tracked separately. But I have sent this on into HUD, so hopefully Kyle will get a definite clarification from that from HUD before we get off the call today at 4 o'clock. But if indeed it's an NSP1 and an NSP2 project, which is what it sounds like, then yes, you'd have to use the NSP1 program income first before you made an NSP2 draw on the same project. Janine, would you agree with that?
I do agree with that, but maybe a HUD would also just to double check. But yes, that's how I understand it.
And let me just check and see, were any of our HUD people able to join us yet? No? Okay, guys, just, the HUD did in fact get evacuated, and I think the phone lines in D.C. are pretty much out as well as cell phones, so they may not be able to join us. Okay, another question from Melissa. Melissa's question was, if a Habitat for Humanity organization is one of your subrecipients, and they finance the homes and have a bank account set up to deposit their mortgage payments into, only the principal portion of the payment is considered program income. So let's stop right there. If you've got NSP funds in this deal, and you've got the money coming back in to your subrecipient, then it is not true that only the principal portion is program income. It's actually the principal plus the interest is considered to be program income, but you would only attribute the portion to NSP that was the portion of the development cost paid by NSP. So, for example, let's say your total development cost was $100,000, and NSP paid for 50 of the 100, and volunteer habitat labor paid for the other 50, then only half of the principal plus interest coming back in would be NSP PI. So it's not true that the interest doesn't count as PI, just as an aside. The rest of her question is, does that portion need to be transferred out to a separate PI bank account, or can it remain in the same account as long as there is tracking in place to separate the program income portion from the portion of the balance in the account that is an escrow for taxes and insurance payments? So I guess the question is whether that escrow is, who holds account over the escrow? Is it the home buyer or is it the subrecipient? If it's the subrecipient bank account that covers both principal and interest payments and the escrow and insurance payments, I suppose it's okay to leave it all in one big account and then track it in your accounting system. I will say I think it's a little bit dangerous in the sense that, you've got money that's escrowed on behalf of a home buyer for taxes and insurance mingled in with what are essentially program funds, which is the program income, and that's inclusive of the principal and interest. So, I guess while I'm not sure it's technically required, I think it would be cleaner and easier to track if you had a separate escrow set up for the taxes and insurance for the home buyer, and then you had a bank account for the money that is program income coming back into the Habitat subrecipient, and that program income would include both the principal and the interest. I think mingling stuff that's on behalf of the home buyer with what's on behalf of the subrecipient that's going to be used for the next available cost is a little bit concerning. But I think if your accounting system can correctly and accurately track that, it might be okay. Janine, what do you think?
I agree, Marcia, that the controls that someone puts in place would be the evaluation that it would make to see if it's okay or not. And the weaker those controls are by putting that all together into one that escrow, the more likelihood or the more ability that someone might miss something here or there. So I agree with Marcia's recommendation to think about that twice.
Yeah. Okay, and again, Melissa, if you have follow-on questions, please feel free to hit *1 to call in. Our next question is from Richard. If program income has been previously deducted from requisitions for new funds for our subrecipients, that's the example we used where we said if you have $5,000 on hand and a $10,000 bill, you would deduct the $5,000 and only ask for $5,000 draw. How should this program income be reflected in DRGR, so the part that was deducted from requisitions? So, Janine, how do you show that in DRGR?
Again, DRGR is very simple right now in that you just have a program income received and a program income drawn. So all that is considered program income, i.e. that $5,000, would have to be shown as received in the activity in which generated that program income.
And then you would show it as immediately drawn, right, Janine, since it was a deduction?
Correct.
Yeah. Okay, terrific. All right, Karen's question. If a grantee is spent over the amount of the initial NSP1 grant, because we have to spend the program income first before drawing any program funds still available. Do we lose the amount left in the program fund account? No. So the money that you've still got in your NSP1 grant amount that you didn't draw down because you spent your program income first, you're not going to lose that money. You're going to still be able to use that for eligible uses even after you close out the program, so long as you have expended the minimum amount you had to expend, which, as we said, was the original grant amount. So as long as you meet that expenditure test, you're not going to lose any of the money that's still sitting in your NSP1 account, and that's why there's not meant to be a penalty for you spending the program income first. Okay, the next one, I can't read this name. Some grantees have properties under LMI activities, but a few homes were sold to LH25 families. Okay, so it's under the regular LMI category, but in fact it was sold to a low-income person, a very low-income person. What do grantees have to do in DRGR to take credit for the LH25 sale? This credit will also help the grantees to meet the LH25 requirement on future PI. So, Janine, if they've put it under LMMI, but it was really an LH25 activity, how do they take credit for it?
Yeah, so this is actually not a program income question, more as what do I do, if I'm reading this correctly, with the funds that were used under an activity that was originally set up as LMMI, and you drew down money for, let's say, acquisition and rehab for those properties under LMMI, but lo and behold, when you come to the sales, those were actually not acquisition rehab costs for LMMI, but rather LH25. Is that how you read that as well, Marcia?
Yeah, I think what they're is they were doing a home buyer activity of some type or other, and it happens that some of the home buyers who came through the door and bought these houses were at 0 to 50, and so they want to take credit for that home buyer under LH25.
So this is a common problem we're seeing these days because a lot of grantees are not positive. So you have two options here. One is you need to revise the vouchers in which you drew down the funds for under LMMI to that LH25 activity if you have one open. So let's say, for example, you're working with a city. The city has the program themselves, and the city's program was originally just for LMMI, single-family acquisition rehab. You need to now create a new activity that's single-family city for LH25 and move those draws, the total amount of the costs that were associated with those properties that were originally thought to be LMMI but were actually LH25 to an LH25 activity. If you need those funds to be counted and credited towards your LH25. That's kind of the first step of the conversation. You need to do that. You do not actually have to go back and find each voucher specifically. You can look at the total sum and move the applicable dollar amounts from the LMMI to the LH25 activity. You will need to do that if you need to get credit for that LH25 sale. Okay? So you need to go back to those vouchers originally and do that. And then any program income off of those sales would be program income received. You would be able to show that receipt under program income received under the activity that is LH25. Please remember as well that you should be only showing performance measures, your accomplishment data, once it has met an end use in DRGR, meaning families in the house, for example, in the sales of this type of property.
Having met the national objective.
Have met the national objective, thank you. And so you should not be categorizing or entering any information for these LH25 sales in the LMMI, but rather only in the LH25 activity. If you have done so in the LMMI, you need to make prior period corrections, which means in your next QPR, you are able to put negative numbers if you need to in the LMMI category.
All right, thanks, Janine. We have a couple more written in questions, one from Laura. If you have a grant of $7 million and $2 million in program income, the 10% cap would be $900,000. That's right. So 7 plus 2, $9 million, 10%, $900,000. Could the 10% come in total from the grant when applying FIFO? Yes. So it could be that you took, so you have in this example, you have $900,000 is the most that you can spend on admin. But it could be that all $900,000 came out of the $7 million that you've got of grant funds, and that the total of the $2 million of PI, because again it was first in, first out, went entirely to project expenses. That would be completely okay as long as the total amount that you spent on admin was no more than the $900,000 that you're allowed to spend, whether you drew it out of PI or you drew it out of the grant account. Would you need to change the grant budget in order to spend funds above the 10%? So this is the issue with the way that it's set up in DRGR, which is that it assumes 10% of the $7 million that they have as their original grant. But if you're really going to spend $900,000 of the original grant, Janine, how would you do that in DRGR?
Same like with the other activities, you do increase the grant budget. I highly recommend when you do so that you make sure you put in your narrative very clearly how you're getting the dollar amount that has increased. So do not assume that someone is making the same calculations as you are. Make sure you put it very clearly in your action plan narratives and during your KPRs how you got that dollar amount and how it looks to your entire grant.
Thanks, Janine. Okay, next one's from Ann. Hi, Ann. Hope you're well. We pay for loan servicing through an administrative services contract and currently pay for this service using a portion of our 10% admin. However, the loan servicing contract is a fee per loan basis. Therefore, all servicing costs can be broken down and tied to each NSP-assisted unit. We believe this enables us to pay for this service as a project delivery cost rather than out of admin. Do you see any reason we can't do this? Well, the issue, Ann, for me is what kind of loan we're talking about. If it's a construction loan, and therefore the project is still open, the activity is still open in DRGR, and it's the servicing costs for the construction loan, collecting the construction loan payments and so forth during that project, then yeah, I guess I would buy that as a project delivery cost if you can tie it back to the unit and you know specifically how much these servicing costs are under your fee-for-service contract. If, however, the project is closed, so we're now talking not about the construction loan servicing, but about the long-term permanent loan servicing, then I don't see how you can tie it as a project delivery cost when you don't have an open project, because you've completed the construction, you're now in the permanent loan phase, and you're connecting the permanent loan servicing. I don't see how that would be possible. It's sort of like long-term monitoring. It's not a delivery cost. It would be an admin cost. So I think it depends on what kind of a loan we're talking about servicing. Janine, would you agree or disagree?
Yeah, I'm not too sure how to make that work any other way than you said.
Yeah. Okay. So, Ann, call back in if that didn't answer the question. Let's see. Our next question is from Vashali. The question is, your presentation is very helpful. When will it be available to us to download and print out to refer as the need comes? Good question. I believe it gets posted later today or maybe tomorrow once the recording comes back. Vinny, do you know when does it get posted?
The presentation actually is up now on the HUD NSP help.info website. If you go to the Learning Center, you can click on this webinar, and the slides should be there to print. However, the full presentation with the slides and audio together won't be available until probably tomorrow or the next day.
Okay, thanks, Vinny. Okay, from Bill. If the original grant is $10 million, total program income at program end is $3 million, total expenditures at the program end is $12 million. Is required loan income set aside as program income 25% of the $12 million or 25% of the $13 million? Well, it's a little bit of the way we need to answer the question is by the time we spend a full $13 million, which could happen after closeout, the LH25 test is based upon the $13 million, not the 12. So while when it comes to closeout, you will have only had to have spent 25% of the $12 million, the total amount that you have spent so far, you're not done because you still got $1 million left to spend. So you're still going to have to spend 25% of that total $13 million once you have expended all of the funds. So again, let me repeat. So the example was grant of $10 million, program income of 3, so that's total of 13, but they've only spent 12 at the end of the program. Thus, they have $1 million still sitting in DRGR. And the question is it 25% of the 12 or 25% of the 13? And again, I think it's 25% of the 13 at the end of the day. Once that $1 million out of DRGR is spent, you're going to have to show 25%. Now, you may not be there at the point that you get, when you've gotten to close out, but you do eventually have to get there is my understanding. And again, we don't quite know how the closeout's going to work, so this, I will give you a caveat that this is our current understanding. I don't know what will happen when we see the closeout notice. Janine, would you read that any differently?
No, I read it the same way. Yeah.
All right, next question. I think this is from Les. Don't we need to know if a Habitat was set up as a subrecipient or developer? If Habitat was a developer, then the principal and interest payments would not be program income. Okay, so this is referring back to the previous question that talked about the Habitat organization. And the question said that the Habitat was a subrecipient. So I assumed that therefore the Habitat was a subrecipient, and we were talking about money coming back into a subrecipient. If the Habitat wasn't considered a subrecipient and was a developer, then it's true that the money coming back into the Habitat, because again, they're not a subrecipient, would not be program income. So the question said they were a subrecipient, but if the Habitat is being treated as a developer, then it's true that the program income coming back, the income coming back into the Habitat would not be program income if they are a developer.
And Marcia, maybe also he was referring to my example on the common problems question number 3, and that's the same here. When I was talking about Habitat, it was that Habitat was a subrecipient, not a developer for my example as well.
Okay, great. Okay, next question from Deborah. How can we account for program income earned and dispersed in a previous quarter that was not reported in prior QPRs? Can we report all program income in a subsequent QPR, or do we have to amend the previous QPR? Janine, I'm going to turn that one to you.
Okay, so how can you account for program income earned and dispersed in a previous quarter that was not reported?
In other words, they forgot to report the program income last quarter?
Yeah.
And they just reported all this quarter, or do they have to go back and change last quarter's report?
Currently, QPRs are snapshots in time, so you as a grantee actually do not have the ability to go back to that QPR once it has been reviewed and approved by your field office. And actually, the field office does not either. The field office would have to call up to headquarters to get previous QPRs rejected. So I would strongly recommend you connecting with your field office to see what their preference is. I've seen many times field offices say very clearly, please put it in this current QPR, do it today, do it now, even we're in quarter, receipt it, save it, and then draw it down so that it shows very clearly that happening during this quarter. Again, some field offices will want it to be clean and show back, and you'll need to connect with them. But if functionality in DRGR, you are able to do that. Again, if you do that and talk to your field office, highly, highly recommend that you put very clearly in your narrative what has happened.
Okay, terrific. All right, so Rochelle, do we have any questions on the phone?
Yes, we have additional questions. We'll take a question from David Wolf with Mohawk County.
Hi, David.
Hello. We're a brand new grantee, NSP3, never had one or two before. And we have a question. It appears that when you get program income back in, you have to amend your grant budgets to increase them by the amount of program income. And then you'd have to do your action plan. You'd have to submit that for approval like at the end of the quarter prior to your quarterly report being due. Is that what I'm understanding?
Well, it depends. On the action plan, it depends on what you originally contemplated in terms of, and I'm not talking about DRGR now, I'm just talking about the action plan. It depends on what you originally contemplated in the action plan. So if, let's say, you contemplated doing acquisition rehab, and that was the activity you described, and when you get more program income in, you're just going to do more acquisition rehab, then you don't have to amend your action plan because it's just more of what's already been approved.
But the
if, however, you wrote about acquisition rehab in your action plan, and now when you get the program income in, you want to do a rental new construction, so that it's a different type of activity, then you would have to amend your action plan. So it depends upon what you're going to do with the PI as to whether or not you actually have to do an action plan amendment. Now, in DRGR, that might be different. So, Janine, how do you do that in DRGR?
And I'm glad you made the distinction, Marcia. So she was talking about kind of that original action plan that's outside of the system. Some people did submit it within DRGR, but the original one that was kind of combed over by HUD, et cetera. In DRGR, you're able to make changes, and some of those changes do mean you need to go back out to a modified public comment period, and some of the changes in DRGR you do not. So you always need to go back and read what it constitutes in a full, what's called, amendment to your substantial amendment, and we're not talking DRGR. In DRGR, like anything else, anytime you change anything in your action plan, DRGR action plan, I'll make that very clear, in DRGR action plan, it changes its status from reviewed and approved back to modified, submit when ready. Even if you're making a grammatical change in one of your narratives because you don't like how it reads, it's going to change it back to modified, resubmit when ready. If it's in modified, resubmit when ready, you literally are not able to submit your QPR, okay? You need to have your DRGR action plan say reviewed and approved, and that the field office, so you would submit your DRGR action plan back to HUD. I highly recommend for anyone, including yourselves, that you make a strong relationship with your field office or your community planning development rep, your HUD rep, and in that, what I've told grantees and has worked very well is that anytime you make any DRGR action plan changes and have to resubmit it during quarters, you give them bullets about what changes. So, for example, in Marsha's example where she actually, created a whole new activity, let's say, it's highly recommended. You have to go through the public comment period and go through that if it constitutes that. But I also recommend when you resubmit your NSP action plan that you put down there, we made a new activity. Some people also say, I increased my budget, so it makes it very clear to them so they don't have to look through the entire action plan. There is no track changes in DRGR, so a field office does not know. So that's how that kind of works. Again, DRGR, simple to make changes. It does not mean that it does not constitute a larger amendment, and some of those amendments constitute public comment period, et cetera.
So if you're just doing more of the same, and your amounts have changed because of program income, you're not creating another activity, not doing anything new, then you wouldn't have to submit an action plan change.
If you're using the same activity types that your program funds are, and you're just literally going into your QPR and receipting that, i.e. showing your program income receipt, and then going to your drawdowns, no, that doesn't touch an action plan.
Okay.
And just think about it this way, though. For DRGR, again, for action plan, it has to be, the action plan status has to be reviewed and approved for you to submit a QPR, and vice versa. The latest QPR needs to say reviewed and approved for you to resubmit an action plan if you need to.
Okay, thank you.
You're welcome.
Great. Okay, do we have any other questions on the line, Rochelle?
Yes, we do. We'll hear from Millie Davis with Cuyahoga Land Bank.
Hi, Millie.
Hi, how are you?
I just read online that you guys felt that earthquake out there, too.
Yes, it was not as big as the one last year, though, thankfully. So I just have a quick question. We are a consortium of 4 members with an NSP2 grant, and we're just now starting to deal with this program income issue. Okay. If our sub-grantees, I'll call them, consortium members, are garnering program income, and obviously I understand the first in, first out, but we're not physically, they're not cutting a check back to us as the lead entity. Do you still need to account for that in DRGR at this time?
Yes.
Or, yes?
Yeah, you do. Yeah,
okay.
So even though you're letting those members, call them sub-recipients, call them consortium members, whatever you want to call them, even though you're letting them keep the money and not physically cut a check back to you as the lead, it still counts as program income for the consortia itself.
Right.
So you do need to receive that program income in DRGR.
And that's under the quarterly, that's under the QPR, I believe you were saying?
Janine, is it QPR or is it when it's received?
Well, you do it in the QPR module of DRGR.
Okay.
And you're required to report on it every quarter, all the program income you receive each quarter, and that's hence why it's in the QPR. However, many people say to me, oh, but I need to draw it next week, and my QPR is not due next week. Go ahead into your QPR, receipt it then, save it, don't submit your QPR, save it, and then the total of the funds, program income funds received will now be available for you to draw on during the activity.
Okay, so it then tracks it over to the voucher, and so it'll be accounted for, and you can obligate it, et cetera, from there.
So this is the key here. You actually don't obligate any program income currently in DRGR. It's literally a 2-step process.
Okay.
Program income received at the QPR, program income drawn in the drawdown module. That's all you can do.
Okay. Thank you
and the
so much.
enhancements going forward will include obligation. You'll be able to do some budgeting. It will have a more comprehensive tracking. Currently, there's 2 options.
And then as long as we're tracking some sort of internal tracking system to say that one of our partners has program income and then, you know, they're drawing against their own program income before they're submitting new expenditures, then we're okay then.
Correct. And I would recommend putting those into your narratives every quarter.
Okay.
So you're able to demonstrate to HUD, you know, X amount for this subrecipient has been received and drawn and they're keeping it, et cetera. So it's able to be shown by every quarter by your colleagues, your consortium members, as well as then HUD can see a transparent record.
Okay, thank you so much.
Okay, and we're going to, since we started a few minutes late, we'll keep going a few minutes longer. So, Rochelle, do we have any more calls on the line?
Yes, we'll hear from Melissa Irving with City of North Little Rock.
Hi, Melissa.
Hi. Thanks for your response to my earlier question on the Habitat separate account.
Sure.
That answered it well. A second question, if program income has been entered incorrectly on the wrong activity, not the activity that generated it, but the activity that it was going to be used against, is there a way to revise that in DRGR?
Yeah, that's a great question. So I understand you want to revise a previous draw that you did, and it was specifically a program income draw versus a program fund draw.
Yes, and it was drawn against the correct activity, but when it was put in the QPR, it was not put against the activity that generated it. In other words, it was receipted against the wrong activity.
But your voucher was correct?
Well, the voucher, I mean, yes, because it drew it against the activity that I wanted. In other words, what happened was it was receipted and drawn against, say, Habitat Rehab, but it was actually generated from Habitat Set Aside and should have been receipted on Habitat Rehab.
Okay. So it sounds like you need to go back into your QPR is what I'm hearing, if it's all about the receipt module or the receipt section, the program income that was in error.
Okay.
And in doing so, today you can go into the QPR. So you've recently submitted one, open the next QPR up, go into that QPR, and you can now put negative numbers into that.
Okay.
So if, for example, if you know that they're only, you know, this activity has, you know, it was supposed to be $500,000. You put $500,000 and actually it's supposed to be 0 receipt. You can put negative $500,000 into the receipt, or the QPRs currently. So feel free to go into your QPRs and make the adjustments as needed in each activity that it's needed. And again, negative numbers are accepted.
Okay, so it will let you do that even though you've already used that on a voucher.
You need to first go in and increase the activity in which it should have been for.
Okay.
Okay. And then you can decrease the activity in which you want to take it away from. So basically what you're going to do is double and then come back down. So you'll always be above the total draws. You never want to go dip below the total draws because that is when you'll get an error message. So first to the activity in which you want it to be receipted against and add that. And then you'll go to the activity in which you didn't want it to receipt against and you'll subtract that amount.
And then once you do that, will there be any type of revision that you have to do against the actual voucher? Or will it automatically?
If the voucher is correct, you never have to touch that again.
Okay. Okay, thank you.
You're welcome.
Sure. Any other questions on the phone?
And there are no further questions at this time.
Okay, and Kaya Patrick asked a follow-up to her earlier written-in question. Her question was the one about the NSP 1 and 2 agreements with the subrecipient where they have finished NSP 1 but have NSP 1 program income, but now we're doing NSP 2. And so her question was, do they have to spend all of the NSP 1 program income or a proportion to what was invested in this joint project? You know, that's a good question. To be honest with you, I don't know, Kaya. My inclination would say that if it's a joint project, that you ought to just spend down all of the on-hand NSP 1 program income, and then you can do an NSP 2 draw for whatever else you need. But you know, that's just a guess. I think we should run that one past HUD. So Kaya, I would recommend writing this up and sending it into the Ask a Question desk at the NSP website, just to get a definite answer on that one, to be sure about how they want you to deal with that issue of the proportionality. So with that, I think we've actually got all of the questions. I do want to draw your attention to some of the examples that are in here. I'll go back to them. They'll be in the PowerPoint that you can draw down from the NSP website. There's a series of them in here. The answers are in there as well. And they do match out with the July notice. So you can also find more information on all of these in the July program policy alert. So if you want to read more about them and see the answers, you can do that as well. So with that, I'm going to go ahead and close out for this afternoon. I'm going to encourage you to go ahead and fill out the evaluation. Let us know what you thought about this. And appreciate everybody sticking with us throughout this webinar, and appreciate your feedback on please particularly let us know what other kinds of webinars you'd like to see in the future. So thanks again. And Janine, do you want to say anything to close?
No, just mimicking also, Marcia, that the DRGR section of program income is also in the policy alert. So you can also, if you want to read through that and get a better stance. Also, if you have very specific questions around DRGR and really need someone to walk you through something, don't hesitate to request TA.
Great. All right, well, thanks, everybody, and thanks for joining us on this webinar, and we look forward to talking to you on future sessions. Thanks, everybody. Bye-bye.
And that will conclude today's call. We thank you for your participation.